China and California rise above U.S. trade war for action on climate change. Patience, imagination, and perseverance will overcome temporary obstacles of Trump's trade policies, says State Governor. China and California are seeking to push past the trade war to shore up their joint front in the fight against climate change, with a three-day summit in San Francisco this week. The asymmetric joint effort between the world's second biggest economy and America's most populous state has the backing of California Governor Jerry Brown and Chinese President Xi Jinping, who sent a personal message of support to Brown ahead of the summit. But the escalating trade war is already derailing a deal for China to buy more liquefied natural gas from the United States, an agreement made during U.S. President Donald Trump's trip to Beijing last year. The dispute may even cast a shadow over international climate talks expected to finalize details for implementing the Paris Agreement before the end of this year, according to officials at the Global Climate Action Summit. Convening the summit on Wednesday, an upbeat Brown dismissed the US-China trade war as a temporary obstacle for the two countries in developing low-carbon technologies and markets together. Trump is only one part. There will be something else after Trump. So we need patience, imagination, and perseverance to find a common path forward, he said. Brown distanced himself from the Trump administration, calling California the fifth biggest economy after the United States, China, Japan, and Germany. He said China's investment in and demand for clean technologies would be crucial for California reaching its goal to go carbon-free by 2045. In a two-hour discussion, Xi Zhenhua, China's special representative for climate change, said he and Brown had identified various areas where China's localities and California could work together, despite strained ties between the two countries. Zhu Ji, president of Energy Foundation China, said Chinese ministerial and municipal officials were particularly interested in learning about the mechanism that helped California foster innovation in low-carbon technologies and the state's cap-and-trade scheme to curb greenhouse gas emissions. China Pavilion, held as part of the summit, but outside the main venue, was attended and addressed by a series of climate heavyweights including former U.S. Vice President Al Gore, British economist Nicholas Stern, former U.S. Energy Secretary Stephen Chu, and climate chief Patricia Espinosa. Todd Stern, a senior fellow with Brookings Institution and a former special climate envoy for the Barack Obama administration till 2016, said US-China collaboration was absolutely instrumental in moving the Paris Agreement forward, especially as the world faced existential and monumental problems of global warming. The fact Xi did not really have a counterpart to talk to in the U.S. federal government, as a result of the Trump administration's political disengagement on climate change, was making any progress impossible, he said. It was against this background that the state-to-nation engagement for California and China was proposed, in spite of possible pitfalls due to the asymmetry in such relations, Stern said, citing the greater autonomy and independence for subnational units in the U.S. than in China. This exercise to collaborate with important players in China is sort of like having a low flame on the stove. You keep it a little bit warm, and hope one day you can build it up when there is a new national government here, he said. However, the trade spat between two countries is already taking its toll on the two countries' previously agreed cooperation on LNG and oil. There were signed MOUs or preliminary deals for LNG and oil between China's three major oil companies with their American counterparts last year, but all have been stalled now due to the uncertainties in trade disputes, Zhu said. China's demand for LNG was soaring as the country replaced coal with cleaner natural gas for winter heating in northern rural areas, he said. The proposed deal to buy more LNG, which is also less carbon-intensive than coal, from the U.S. is aimed at narrowing the trade imbalance while also meeting China's rising demand. But China's potential tariff on imports of the fuel from the U.S. as part of tit-for-tat trade actions will not only hurt the exporter, but also bring uncertainty to the country's long-term transition towards clean energy. To realize the 2050 goal for China to go green, we need LNG as a transitional fuel to replace coal, and we need it fast. We need all infrastructure to be built by 2030, so it can be replaced with renewables by the mid-century, Zhu said. But with the sudden changes in trade relations, there are more uncertainties now. China targets American diamonds, alcohol, and LNG, with latest tariff threat. consumers of high-end products could feel the pinch if Beijing's new duties on U.S. imports come into play. After China threatened to impose new tariffs of between 5 and 25% on U.S. $60 billion worth of goods it imports from the United States, we take a look at some of the items that might be affected. Liquefied natural gas. Beijing's threat to slap a 25% tariff on imports of liquefied natural gas from the U.S. is most likely a response to President Donald Trump's repeated pledge to make the U.S. a dominant player in the global energy market. During his visit to China last year, Trump said that buying more LNG would be a way for Beijing to reduce its trade surplus with the U.S., which led to state-owned China Petrochemical Corp., also known as Sinopec, signing a U.S. $43 billion deal for an LNG project in Alaska. Partly driven by its efforts to reduce pollution caused by coal burning, China last year became the world's second-largest importer of LNG, according to figures from S&P Global Platts Analytics. In the first 7 months of 2018 it imported more than 1.88 million tons, up from 1.61 million tons in the whole of last year. Alcohol. Alcoholic drinks from America will become more expensive if the new duties come into play, with a 25% tariff slated for beer, wine, brandy, gin, liqueurs, and tequila, and a 20% levy on rum and vodka. Some cordials will also be hit by the 25% duty. With its growing middle class, China is now one of the world's leading markets for alcohol. Of the $0.53 billion worth of wine exported by the U.S. in 2017, about 5%, or $79 million, went to China, according to California-based Wine Institute. Meanwhile, sales of American liquors to China have also grown exponentially, from $959,000 in 2001 to $2.8 million in 2017, according to the Distilled Spirits Council of the United States. Diamonds, pearls, fashion accessories, and clothes. In a swipe at the luxury end of the market, Beijing threatened to impose 25% tariffs on a host of high-end goods, including watches and jewelry, and the gemstones used to make them, such as diamonds, rubies, crystals, and pearls. The same duty would also be added to selected items of apparel and accessories, including dresses, knitwear, leather bags, and purses. Gold accessories would be slightly less affected, with Beijing proposing a 20% tariff. China is the world's largest producer and consumer of gold, with its jewelry market accounting for 30% of global demand for the precious metal, according to the World Gold Council. The proposed tariffs would be damaging for America's luxury brands that have seen their sales in the world's most populous country soar in tandem with rising living standards and booming wealth. Can China switch 70% of northern cities to clean heating by 2021 in bid to tackle pollution? Plan will see volume of coal burnt fall by 74 million tons by 2019, Beijing says. Beijing aims to have half of northern China heating their homes with clean energy by 2019 and 70% by 2021, state media reported, under a new 5-year plan for the region. Reports of the plan over the weekend come amid a deepening heating crisis after a government campaign to switch millions of households and thousands of businesses from coal to natural gas in northern China this winter backfired. Severe natural gas shortages have sent prices soaring nationwide, hitting businesses and residents across China's industrial heartland. The plan, from 2017 to 2021, was drafted by 10 government agencies, including State Planner, the National Development and Reform Commission, and the National Energy Administration, the official Outlook Weekly reported over the weekend. The government has made concrete arrangements regarding geothermal heating, biomass heating, solar heating, gas heating, electric heating, industrial waste heating, and clean coal-fired central heating, Securities Times quoted China Energy News as saying in a separate report on Sunday. Half of northern China would have converted to clean heating by 2019, reducing bulk coal burning by 74 million tons, the report said. That reduction should reach 150 million tons by 2021. At present, only 34% of the region uses clean heating, Outlook Weekly said. Strategies for clean heating fuels and a heating network were also set out in the plan, and clean heating technologies were identified for different areas. Factories are closing or operating at reduced capacity in the region, while businesses are seeing profits shrink as supply chains are disrupted, and residents are struggling to keep warm in sub-zero temperatures without adequate heating at home or in classrooms. The campaign to convert coal to gas is part of long-running government efforts to clean the region's toxic air after decades of unbridled economic growth. Zhu Dandi, an executive vice chairman of the China Energy Research Society, told Outlook Weekly that China consumed more than 200 billion cubic meters of natural gas annually, and nearly 40% of that came from imports. China would continue to rely on imports for a very considerable period, according to the magazine. A reduction in imports of natural gas has exacerbated the shortages this winter. Yao Qiang, dean of Tsinghua University's graduate school and a thermal engineering expert, estimated that China's average daily demand for natural gas had gone up by 42 million cubic meters this winter because of the clean heating campaign, Xinhua reported. But he told the official news agency that the delayed Sinopec liquefied natural gas terminal at Tianjin, which had been expected to open this year, had reduced the daily supply by 20 million to 30 million cubic meters alone. Yao said that supplies from Central Asian countries were also down by 40 million to 50 million cubic meters per day. On Saturday, PetroChina began diverting nearly 7 million cubic meters of natural gas from the southern province of Guangdong to IC northern China to ease gas shortages, state television said on Sunday. Chinese oil and gas major CNOOC had also started supplying some 3 million to 5 million cubic meters of natural gas per day from the South China Sea and its liquefied natural gas terminal in Zhuhai to fill the gap in Guangdong, it said. The gas swap was organized by the NDRC. Gas shortages also spread to Changsha, capital of the central province of Hunan. Households that have bought 1,500 cubic meters or more this year were limited to buying 15 cubic meters per day from December 15 onwards, state television said. The gas shortage in Changsha could exceed 60 million cubic meters this winter, it said.